Basically, every single year, the media will peddle out these stories of there's a recession around the corner, this is going to happen next. Kind of scary stuff, right? But that happens every single year. Eventually, they'll be right, but it's just always a permanent feature of the news media. There's also talk of, markets going to fall, markets overvalued, prices are stretched, everything's expensive. That has been a feature also of the news media every single year. If you go back and Google it, you'll be able to find news stories from every single year going back the last 10 years that the market's overvalued, and the market has performed extremely well over that period of time.
The Aussie Fire podcast is a collaboration between Strong Money Australia and Pearler, Australia's favourite boring long-term investing platform. Join our hosts, Dave from Strong Money Australia and Hayden from Pearler, as they discuss all things financial independence. At Aussie Fire, we're big fans of sharing experiences and talking about money. However, please note that any advice is general and does not consider your financial situation, needs, or objectives. Consider whether it's appropriate for you, and if in doubt, speak to a licensed financial advisor.
Hey guys, welcome back to the Aussie Fire podcast. In today's episode, we're going to be doing a Q&A for you. So we'll be discussing some interesting topics that we definitely haven't featured on the show before. One of those is going to be talking about investing lump sums when the market is at an all-time high. So I'm sure a few of you are probably wondering about that sort of a situation. Some of you might be facing that, or others have probably faced it sometime in the past. So we'll talk about that and unpack how we see it and what we might do in a similar situation. We'll also be talking about gearing inside super, which almost never gets discussed. I certainly haven't seen it mentioned many times at all, so it'll be good to talk about that. And then we'll also be discussing a question around investment bonds, which are also sometimes called insurance bonds. And so they get thrown around as a potentially tax-effective option for investing, especially in the FIRE community. So we'll talk about those and see if they're as good as promised or as good as it says on the label sometimes. So it should be good. And as always, don't take any of this as investing advice. This is just two guys having a chat on a podcast. So always do your own research, yada, yada, yada. I think you get it by now. Over to you, Hayden. What do you think, mate? You pumped?
Yeah, I'm super pumped. I love Q&As. I think it's important for our listeners to remember that Q&As come from other Australians like yourself, everyday people. So if you are someone who has a particular question that you'd like answered, you could very easily share it with us. The easiest way is to follow the link in the show notes, though you can also email us at hello@aussiefirepod.com, or alternatively, you can reach out to us on socials at either Pearler or Strong Money Australia. But I reckon we get straight into the first question, Dave. I've got it up here. I'm really interested in talking about this question too. It says, I'm hesitating about how to invest a $300,000 lump sum that I've extracted from home equity. I read Dave's article on lump sum investing, but my hesitation comes from the fact that both the Aussie and US markets are sitting at historical highs. I'm worried about overvaluation risk. What if I'm buying at the peak?
It's a pretty good question. There's definitely not the only person who's wondering something like that. So, let's unpack it. First of all, let's just say that in my article on lump sum investing, I'm not saying here's why you should do lump sum investing. I'm saying if you have a lump sum to invest, here are the ways you can go about it. So let's just clarify that. And so when you do have a lump sum, there's a few things you can do. Obviously, you can put it all in straight away, and that tends to be statistically the most profitable path to choose because, as we know, the market tends to go up most years, which means the longer you take to invest your money, on average, the lower the return is going to be, or the more you kind of miss out on the market's gains over time. But there are cases when that doesn't happen. I think it's like 3/4 of the time the market's up over a 12-month period. So that means a quarter of the time you would have been better waiting. And so that's the part where people get nervous, or the part where people think, well, maybe it is better to wait, especially if the market has been strong as it has been recently as we record this podcast. So it is important to consider, and there's a lump sum involved. So it is a bit more stressful and a bit more anxiety inducing than your regular investing. So if we look at your approaches, like I said, you can put it all in at once, or you can drip feed it in over time, or there's a middle ground approach, which I quite like, which is you can put in some of it now, like a small chunk or whatever you're comfortable with, and then you can dollar cost average the rest. And so if you do that, you kind of get the best of both worlds in a way where you're putting some of the probabilities on your side, but you're also not taking that big timing risk of putting it all in now, because there is that chance that it does turn out to be not a great time to have made that giant purchase, if that makes sense.
I think that makes a lot of sense to me. I've had to put money in at all-time highs a few times, Dave, and I definitely get really worried about the market going down, for sure. I think for me personally, I probably mitigated that by trying to put in smaller amounts or trickle in little bits as I go and kind of, basically do that dollar cost averaging, which makes a lot of sense and it works pretty well. I think probably just a more kind of important note that I'd share with people is whilst markets are at all-time highs, markets are very often at all-time highs. It's pretty common because, they tend to be up a lot. And I think one really important thing to do when you look at market charts is make sure you're either looking at a logarithmic chart or make sure you're looking at a chart logarithmically in your head. And what I mean by that is that the charts can get really scary because it kind of looks like if you go back to 2000 that it kind of and then it like really rockets up at the end. But if you actually just think about how the math of it works, it like to go from 1000 to 2000 takes 5 years, but then to go from 2000 to 4000 takes another 5 years because of compound interest, right? So you should really expect that charts actually do pick up the pace in which they go up if it's just a linear scale. And by linear scale, I mean it just goes like 1, 2, 3, 4, 5,000 on the y-axis. Whereas a logarithmic scale kind of goes like $100, $1,000, $10,000 like that. That's kind of the scale without getting too mathematical. But I think that's just important because sometimes markets are really high, but when you look at it, it's like, oh, they've kind of just generally been steadily going up. It just looks worse than it is. And in those cases, I think that's useful because I know people that have avoided investing when the markets are high because they're at the highest ever, when their actual rate of growth has been not that absurd and not that different. It just can look like it sometimes because of how the chart looks.
That's a good point. I think it's probably interesting it's probably going to depend on how the listener or how anyone is actually arriving at that nervous point where they're thinking, the market is at an all-time high. So are they looking at charts or are they listening to the news or reading the news? So it depends how they're looking at it. If you've described the chart scenario where that can be a little bit misleading if you're looking at it that way, but sometimes it can just be media chatter. And so when you use the phrase record high or all-time high, as the media loves to do, and they do this with property as well, property prices, all-time high, record high, whatever. But like you said, it doesn't really mean much. Like it doesn't mean anything because markets are often, property markets too, are often at all-time highs. By definition, they can only be at an all-time high or down from their highs. They can't be anything else, right? And so they've either fallen or they're at an all-time high, technically, so it's quite interesting. So that statement itself doesn't really mean anything to my mind. So when I see that, I just kind of ignore it because it's kind of a useless statement.
Yeah. So like you've heard about the Warren Buffett indicator. Have you, Dave?
Yes. Is that market to GDP or something like that? Yep.
Yeah. So, this is something I've been interested in personally for a while reading about is like the Warren Buffett indicator basically says like how fast does the stock market grow and how fast does the American economy grow, right? And if the the US stock market is growing at 10% per annum, but the US GDP is growing at 3% per annum, then I'm not saying this is what Warren Buffett or the indicator think, but like, a intuitive person might be like, that sounds a bit bubbly. That sounds like if, the economy is only growing so fast and the stock market's growing faster, that could be because it's overvalued, right? And they're also kind of scary thoughts to look at. But on the flip side of that, you could also say, well, maybe the stock market's more efficient because it's not including all of the poor performing parts of the GDP. Maybe it's including inflation and all of this other kind of stuff. And it gets really difficult to dissect the truth in that. And, just at a personal level, when I'm looking at putting my own real money that I've worked hard for, I generally try and put money in sooner rather than later, unless things look absurd. And what I mean by absurd is if I know that the long-term average growth of the S&P 500 is 10%, then if it's 16%, 18% for the last year, I'm not going to be like, oh, it's the end of the world or anything like that. But if the S&P 500 was up I don't know, 38%, Dave, since last October, then I would just intuitively be a little bit like, this feels a little hot, you know? Like, I don't know how the stock market could be worth 40% more than last year. And in that case, then I'd probably just be more hesitant. But that's not even because I'm an economist or anything. That's just because I just don't want to look like an idiot. And there's no real cost to me putting it in gently over 6 months instead of upfront is kind of how I think about it for my circumstances and my headspace.
Yeah, it's an interesting discussion because then the way I look at that is, okay, it went up. Like, let's use your numbers and let's just say something went up 38% or 40%. I would say, well, what was the context a year ago? Maybe the market was undervalued.
Exactly. What if it was down 20% last year? Yeah.
Yeah. So what's the context of that performance? Like, is the context of that a terrible drop before that? Or is it a terrible 5-year period before that? I would want to know like the bigger context so you can kind of put things together rather than look at absolute recent performance. So I think that can be
100%. And to paint Dave's example, the S&P 500 is up 25% over a 6-month period, right? However,
that's very strong.
if you zoom out, it's only going to be up. I mean, I'm just trying to do the quick math. It's only up about 10% since February, right? Which is about 8 months at the time we're recording this. It's October right now. And what that means is like that 6-month figure of like, oh, it's up 25% in 6 months doesn't take into account the fact that that's basically taking the start of that from the middle of the Trump tariff period, right? Like that's what was happening 6 months ago at the time of this recording. So that's exactly Dave's point. So it's very tricky to just look at numbers and stuff without understanding the broader context because things bounce up and down all the time. And that's why like long-term averages are really useful. You know, one of my favorite things, and I fully acknowledge again, Dave, that this is completely baseless, idiotic kind of stuff. But if I'm ever like, oh, I wonder if an ETF's overpriced, I just go get a chart that's, again, logarithmic. And I just be like, does it roughly look like it's a straight line? You know? And if it roughly
as in
looks
the
like it's a straight
trend,
yeah, like if like the 20-year trend is just like relatively straight up, then I'm like, oh, this seems fine, likely fine. You know, I'm not going to lose sleep over it. If it just looks like a straight line and then at the end like rockets vertically, then I get a little bit worried. But the great thing about so many ETFs is that they're all pretty stable at the end of the day, like VAS, VGS, like if you really look at most of them, the only times I've seen people buy ETFs and have bought it at highs and watched it go down for a while is when everything's going down. Everything's going down. And very rarely do I think people notice it anyway. Like, can people predict it anyway, I should say.
I think that's the trouble when you start trying to look at valuations and things like that, because there are a lot of different ways to measure the valuation or the expensiveness of the market. And to be honest, a lot of them are very interesting, but if you actually look at them over time, several of them haven't been very good indicators whatsoever. So I can remember back when I first started investing in shares in 2015, people talking about the CAPE ratio and this ratio and that ratio and, you know, earnings multiples and all the rest of it. And a little bit like recession talk with predictions of recessions, where basically every single year the media will peddle out these stories of there's a recession around the corner, blah, 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 blah. This is going to happen next. Kind of scary stuff, right? But that happens every single year. Eventually they'll be right, but it's just always a permanent feature of the news media. So a bit like that, there's also talk of, you know, markets going to fall, markets overvalued, prices are stretched, everything's expensive. That has been a feature also of the news media every single year. If you go back and Google it, you'll be able to find news stories from every single year going back the last 10 years that the market's overvalued. And the market has performed extremely well over that period of time. So the valuation metrics that people tend to follow haven't actually been very good at predicting much of anything at all. In fact, if you were to ignore them, you would have done a lot better than if you were to acutely be aware of them and pay attention to too many of like expert predictions and things like that. So it's extremely difficult because even if those metrics are saying certain things, what do you do with that information? Because you're still beholden to the probabilities that the market will continue to go up more than it will go down. So I don't understand how actionable that information is. And then if they say it's overvalued, how much overvalued? 20%, 30%, 70%? Like it's just going to depend who you listen to. And then what are you going to do with it? Like Are you going to change your strategy to the point where, okay, I'm not going to buy any shares at all until the market drops 20% because it's whatever, 20%, 30% overvalued? Or are you going to invest less? Because you have multiple approaches, right? You can invest the same amount as normal and just ignore it and just work on, the law of averages and probabilities and expecting things to just generally continue on their long-term trend. Because I suppose the thing that people have gotten wrong is that the market's been able to perform so strongly because tech companies have been able to massively increase their earnings at a faster growth rate than almost any group of companies in history for a fairly long period of time. And so that's what everyone was getting wrong, I think, about, 10 years ago or for the last 10 or 15 years is these companies are not like companies of the past. And that's not to say that they won't fall and their earnings won't start to deteriorate at some point or anything like that. But it's just to say that the people who are predicting that have been wrong for a long time. Eventually, at some point, that will change, I'm sure. But yeah, looking at old metrics of like price to earnings ratio and things like that hasn't been very useful when it comes to these tech companies. So it's extremely difficult. There's been professional investors that have bet against the market and have been kind of hilariously wrong for quite a long time because they expected everything to return to some sort of a long-term average in terms of PE ratio or CAPE ratio or the Warren Buffett indicator that you mentioned earlier, Hayden, but it just hasn't because some things have fundamentally changed in terms of how the companies work and how much money they're able to make on such a small amount of tangible assets and how much money per employee they can make because everything's digital. And a lot of different things like that. So it's kind of like a crazy new era. No one is exactly sure what the right valuation is for a lot of these companies. So that's what's making it so kind of confusing, I think.
For sure. So, I think above all else, statistically, the answer is always going to be to put in a lump sum. If you feel like you can't stomach it for rational or irrational reasons, then the answer is to dollar cost average it in, just so you can sleep a little bit better at night.
So did you touch on what you would do if you had a lump sum right now, Hayden? Would you dollar cost average or would you lump sum it in?
It's a good question about what I would do. I think given the markets have been strong for a long time, Dave, I personally I'd probably take half of it and I'd probably dump half of it straight into the market. And then I would probably try and automate through Pearl, obviously, but because Pearl has Automate, or if your broker doesn't have Automate, then some kind of manual thing. But I'd then put the rest in over 6 months. I'd pick an amount and I'd do that just so I can sleep at night. Because if there was a COVID crash tomorrow, I'd feel like at least I got to benefit half of it. And if the market kept going up, I'd be like, well, it's all right. I got half of it in early. And that's probably just what I would do. I think it was a little bit different when it came to the debt recycling stuff. I tried to put that in more aggressively at the start, but that's because there's the tax benefit once it's in. So I kind of looked at the debt recycled stuff as there's a time benefit of having it in soon, even if the market doesn't do well. So that kind of pushed me more towards 3/4 in at the start. But just generally speaking, yeah, if things feel like it's not a clear dip moment, I would rarely put in a ton of money at once, unless that money was a fraction of my net wealth. Let's say, at this point, if I just stumbled upon $10,000, I just put it all in because that's a smaller proportion of my net wealth. Whereas if I stumbled upon $300,000, which is a lot of money, then I'd probably be more careful about it. And again, it's all just about psychological safety and not even really grounded in anything about stats.
Yeah, a lot of it is contextual to your situation and then also psychological to your own personality, let's say, because some people will just not be able to stomach it. Especially also it's going to matter if there's debt involved. If you've got if that was just pure 300 grand in cash, I wonder if this person would be just as nervous about it as because it's $300,000 in debt. I'm not sure if they feel differently about it, but my guess is they probably do. They probably feel like that is a way bigger deal and a way bigger risk to kind of manage and tolerate in their head because they're in the back of their mind, they're thinking, if I put this 300 in, then the market drops and now it's only 200. I've still got 300 grand of debt that's related to that investment. So I think that's going to weigh on them far more psychologically. So it is tricky. You kind of have to think about what kind of situation you're going to regret more. Not putting the money in or putting it in slowly and then watching the market go up and missing out on more gains, or putting the money in more aggressively and then seeing the market go down. Which one of those is going to be harder for you to stomach?
Yep. What would you do?
Based on my situation right now, if I had, well, I actually just put in a small lump sum because I sold a property, but I have to keep the rest of it for putting it into super. So actually, I was going to put in the entire amount, which is, funnily enough, it's actually about 300 grand from selling the property. So I was planning to put all of it in, but because I'm going to be putting a chunk of it into super, I've kept that aside until like closer to May, June time. So yeah, I would have actually put in the whole lump sum, but either that or 50-50, a chunk now and then dollar cost average the rest. I don't think I maybe have the patience to take such a massive amount and only invest a small amount each week for like 2 years or something like that. It's too long. I just don't think that's probably going to work out. And it also helps if you have regular ongoing cash.
I think it's easier once you're deeper in your journey.
Is it though? Because like if you're earlier on, don't you just want to get as much money invested as soon as possible? That's how I would kind of think about it.
I actually think, Dave, that for me, the longer time goes since I first started investing, the easier it is for me to lump sum. And it's just because I've had more wins in the space. You know, it's kind of like I don't mind a flight delay if the last 10 flights I've caught weren't delayed. You know, like I don't feel like I caught the bad end of the stick. But if I don't fly and then I fly for the first time in 3 years and then they cancel my flight and say the flight's tomorrow, I get really upset. I feel like I took a stab on wanting more from the world and it just punched me in the face, you know? And that's kind of how I feel about lump sum stuff. So I find it easier over time because I feel like I've had enough good experiences to kind of take the fact that maybe there's a bad outcome when it comes to the lump sum. But, you know, I'm very nervous with this stuff naturally, and I'm very scared of loss. So that's just myself. But you're kind of right in the sense that if you think practically, it's the person who's just started investing who actually has the most reason to do things in a lump sum fashion at the start, right? And not kind of drag it out or wait for it.
Ideally, yeah, but it's also, I mean, you can only invest in a way that you're comfortable. It's all well and good understanding the theory and the probabilities, but if you're just not that comfortable with it, no amount of reading is probably going to overcome those emotions. It's probably going to be an experiential thing, like you mentioned, like just building up more wins and more time under your belt, understanding how the market moves and really getting comfortable with it, and to the point where you can stomach more severe drops in your account balance and the ups and downs that come with long-term share investing. So I think it'll happen over time. So if you're listening to this and you're not comfortable putting a lump sum in, don't feel like that's necessarily the best approach for you, because you might do it and then panic later. So you definitely don't want to be in that situation either, because that can be destructive.
For sure. All right, Dave, let's move on to our next question from one of our listeners. This one's about geared ETFs, geared super, some kind of leverage when it comes to super. The question is, there's an option that not many people in Australia talk about much, geared superannuation. Basically a super fund that uses leverage to boost the risk and return in your super. I found it while thinking about how if my super was in an SMSF, I could get a mortgage and buy property with it, earning returns on the borrowed amount rather than just the invested amount. But since I prefer shares to property long-term, I looked into getting an investment loan to buy shares and found this instead. The fund I use is Colonial First State Geared Australian Shares Option. I've seen solid results, and the key factor is you're capitalizing on the superannuation tax advantages compared to standard ETF investing. Wow, this is a very interesting question. And I think the premise of it makes sense, Dave, in terms of, you know, property is obviously useful if you can invest in it because you get the power of leverage. Wouldn't it be great to do the same kind of thing with shares? I know you're a big fan of geared ETFs generally. I think you've told me that you use geared ETFs in super from memory, if you could as well. But I'd be kind of curious in your take about just geared stuff in super generally, and also if what this person is doing seems to make sense, or if there are other options people might want to consider.
Yeah, I hadn't actually looked at this fund before, the fund that they've mentioned in the question. So it was interesting to kind of have a bit of a look at that. So it looks like this particular fund has, I think the fees are kind of high. Like I think they were somewhere around 2% per annum or so. And that's probably because when you have a geared fund, the fees tend to be double because there's double the assets under management. if that makes sense, because half of it, like they take $100 and then they borrow $100 and then they invest $200. So technically they're managing $200 and then they charge fees on the $200. So you kind of have a higher management fee there. So that's one thing. But I had a look at the fund performance for this one, and it looks like over a 10-year period after fees, the fund has returned 16.2% per annum versus the market, which has returned 9.8% per annum. So you can see that there's a fairly significant difference in performance there over a 10-year period after fees and all that. And this is actually quite an aggressive geared fund. So some of the funds that you'll see are like 30% geared or 50% geared. So basically they give you like 1.5 times exposure, let's say, to the market. This one actually gives you 2 times exposure to the market. So it would be fairly volatile. I didn't manage to see like a long-term performance chart, but I can imagine it would be pretty pretty exciting in terms of the ups and downs, let's say. One thing I noticed was it was a bit unusual in terms of the return. So it looked like it had like 14% income and 2% growth out of the 16% return, which is kind of the opposite of what I would have expected to see. I would have expected it to be a high capital growth fund rather than a high income fund. So I'm not actually sure why that is. Maybe there's quite a bit of turnover inside the fund, or that's to do with the rebalancing because of the leverage that how they manage it or something like that. But I mean, those factors aside, it's definitely performed fairly well over time. And it's actually kind of timely that we're talking about this because I just published an article talking about my new super strategy. So for quite a long time, I've had a fairly plain vanilla super strategy where I invest in the indexed shares options inside the Australian Retirement Trust super fund. So I've been in that for years now and I'm fairly happy with it. It's very simple, but I've recently switched to geared ETFs in my super, and that is using the new super option at Pearler. And I've managed to make my portfolio basically 100% geared ETFs. And it's for the reason that we've pointed out here is that you can achieve much higher long-term returns. And the reason I think it can be quite useful in super, because for me, I'm not going to be tempted to touch that money because number one, I can't access it. So I'm not really going to freak out and pull the money out because I can't anyway. I'm probably not going to tinker with it because it's just going to be a set and forget 30-year strategy. And then I can also add money to it on a regular basis. So you get the benefit of dollar cost averaging during volatile markets. So that can be useful as well. But I do expect it to have a fairly decent, like a fairly sizable difference in terms of long-term returns, like maybe 1 to 2%. I think I estimated roughly like 1.5% per annum, which doesn't sound like much maybe, but it adds up massively over like 30 years.
I think it's worth pointing out Dave's obviously talking about using Pearler Super. That's not Dave trying to sell, Pearler Super in their geared ETFs. I think for our listeners,
it's not an ad, by the way.
Well, Dave specifically is the reason geared ETFs exist in Pearler Super because they didn't exist in Pearler Super. And then Dave was like, hey, I like my super fund, but you know what would be awesome? You don't do this. And then it was a long process of people making El Capitan Dave here happy. So that's where Dave's interest in geared ETFs comes from. Is kind of the other way around, is that he willed his geared ETF passion into existence so he could tackle the strategy. And a fun fact, Dave also managed to will my geared ETF interest into existence. I have to be careful, otherwise it makes Dave sound like a financial advisor. That's not the case. But I ended up changing my super portfolio to geared ETFs as well. After kind of having some conversations with Dave, because to his point, it's kind of like, I think there's a part of you when you invest, right? Like if you invest in a geared ETF outside of super, you know that it's going to give you better long-term returns if it's the right structure and things like that, because it's just amplified, it's just leveraged, sure. But there's a little part in your head that's very what if. What if we have a really bad few years in the market? And what if I really need that money? Or what if I want to buy a house? Or what if I want to do this? Or what if I want to do that? And, I think Dave just makes such a strong point about superannuation as a concept kind of protects you from yourself, because there is no interim. Dave's 35, I don't know, something like that, around about that.
I'm 36, but I look 35, let's say that.
Yeah, Dave looks 35. So he's got 25 years. And, does Dave believe that a leveraged broad-based diversified investment product that he believes in has good long-term 25-year prospects, yeah, the interim's irrelevant because he can't touch it. So, I think personally it does make a lot of sense. I can't speak for specific products because I've learned that different types of leveraged or geared products can be kind of subtle in their differences. But, the core idea of like accessing leverage in a product or space you believe in, if you don't have some kind of servicing costs that you might theoretically not be able to afford, they're just good things.
Yeah. And just another aspect of the geared super, I think part of the benefit is, I don't know about you, Hayden, but my super fund is not something that I check all the time. So even if it is more volatile, I'm not going to have that, let's say, slammed in my face all of the time because I'm not actually going to be checking it constantly. So I won't actually feel the stronger volatility as much as I would in my personal portfolio, just out of pure habit.
I agree, though I'd take it one step further and say it's not even that I don't check it a lot, because I probably check my super once a month, which is probably a lot compared to a normal person. But because the money that's deposited into my super is not money I ever really saw and it was paid by my employer, I just can't make sense of the value when I log in.
It doesn't feel real because it's a future Hayden thing.
Well, I didn't put them, like, I log in and it's $250. And I'm like, I don't even remember what it was last time. And then, is it $250 because it's up? Is it $250 because I got paid by my boss? I don't know, because I never saw the money my boss paid me. I didn't get a Westpac notification saying this money's like, so the abstraction of it, it's the same point Dave's making, just slightly nuanced, as it's just so difficult to quickly understand. Whereas like, if you invest outside of super, you took $1,000 that you had that you could have crashed on a car accessory or something, and you took that and you deposited it, or you saw it go out, or if you're automating, you got the notification of it going out. Like, you're so aware of what's happening that it's really easy to see fluctuations. Where super, you not only don't check it, but when you do, it's got all these different things mixed into it. It just makes it hard, and that is a good thing because it can make it stress-free.
So because it's free money, because your super is free money, Hayden, because you're not, I get what you mean. You're not actually putting your hand in your pocket to take the money out to put it into super specifically. So it feels a little bit different. Maybe mine is a little bit similar where I'm not, this is probably key as well, actually. I'm not reliant on my super as a part of my FI strategy. So super is outside of my FI needs, and I consider it to be like bonus money, basically. So I don't mind taking extra risk because I'm not going to be super reliant on the outcome either way. So I think that's probably important, because if let's say you're in your 50s and you're going to be hoping to turn your super into an income stream at age 60, and your time frame is not actually that long, then gearing your super up to try and maybe make up for not saving enough, maybe not the best idea given the time frame and how reliant you might be on it. I wouldn't be doing it in that sort of a situation. So again, it's going to be situational specific, isn't it, to the individual, as always.
100%. And I think just the biggest thing with super, particularly if there's any young people listening, is like, just get started early. Start caring about what's in your super early. Other people out there will have to contribute to super for years to make up for what a young person gains by just choosing intelligently what's in their super when they're young. So, if you're under 30, if you're under 50, frankly, listening to this, but like really specifically, if you're under 30, or hell, if you're under 25, like, my God, just give yourself half a Saturday and log in and think about it, and look at super platforms and think about it. It's just one of the easiest financial decisions over a 40-year period you're going to make to be engaged with that.
It can make such a massive difference. Like, we're talking $500,000 to $1 million plus, and not even necessarily talking about gearing up your super to get extra returns, but even just finding a lower fee fund, like 0.5% per annum or something like that, that can add up to massive, massive money over the course of a working life. So it doesn't necessarily have to be taking more risk, let's say. It can just be any sort of a minor tweak to improve your overall net returns to yourself, which can include reducing fees.
100%.
All right, so our last question for this episode is about investment bonds. The listener says, what are your thoughts on investment bonds, also called insurance bonds? I've been told they're a good option for investing with less tax, and after 10 years, you can sell completely capital gains tax-free. Is that right? Hayden, have you ever looked at these products or heard of them before?
I had a quick look and no, not really. I understand that they're a little bit different to other types of bonds, but no, they've never really come across my radar. Maybe it's because I don't know enough. I guess my world's very ETF centric. It kind of reminds me of all those other things like options and derivatives and futures and just all these other terms that I don't know a lot about. But have you dabbled in these investment bonds, insurance bonds before, Dave?
I haven't actually dabbled in them as in owned any myself, but I've looked at them briefly just because people have asked me about them. And to be fair, they can get a little bit complex or a little bit tricky. So they're not actually, the first thing to understand, I guess, is they're not actually bonds, how you would think of like a bond fund where
like
it might
government
own
bond or something.
Exactly. It's nothing to do with that. It's not owning government bonds where you'll earn interest and it'll have a stable value. It's basically a little bit like its own structure. So if you think about it like an insurance bond instead of an investment bond, because then that might be a little bit confusing, where it's its own structure. And so it can have its own assets inside it, where you can use an investment bond to invest in an index fund, for example. And these are set up by certain providers. There's one provider called GenLife, and I believe there's a couple more in Australia. And basically you can set it up inside this structure. The structure itself covers, there's a certain special tax ruling of the structure itself, and then you can basically pull the money out after 10 years and you won't have to pay capital gains tax on the money. So it sounds good on the surface because you can say, okay, well, let me invest in this insurance bond or investment bond, and I will choose to have that invested in a Vanguard index fund. And then after 10 years, I can pull the money out tax-free. So that sounds kind of good on the surface.
What is this, like a term deposit for ETFs or something?
It's a structure. Think of it like a structure, like a special trust or something with rules.
Sure.
So it sounds okay on the surface, right? But then the structure itself actually pays the tax. So you don't actually own the underlying index fund. The structure itself pays a tax, and the tax rate is 30%. So then you think, okay, well, if I'm a high income earner, I should invest through this structure because that's a lower tax rate than what I pay personally. So that actually sounds good on the surface. But the problem is you might save some tax on the dividends from the fund, but also the fund itself has to pay tax on the capital gains inside the fund as well. Not like, so it's a bit like a super fund. You know how the super fund, the whole return is taxed, not just the income from the fund, if that makes sense. So the whole thing is taxed. So that's usually not mentioned in the marketing from the investment bond providers. So the tax rate is 30% on all of the returns. So straight away you start to lose
unrealized returns.
Yes, all returns. So the reason you can sell or get your money out after 10 years without paying capital gains tax is because capital gains tax has kind of already been harvested along the way. Like how you can switch the option of your super fund without incurring any tax. That's because the fund has already been taking out the tax the whole time. Does that make sense?
Yeah, sure. I mean, it reminds me a little bit, the fact that you say 30% tax rate makes me think of like a company, because that's the corporate tax rate in Australia, right? I mean, I don't know if you know this, but it makes me wonder tangentially, like, is there a reason people with high incomes don't just start companies and then invest in ETFs through their company and then pay 30% tax that way? Because this is kind of ringing those bells to me.
I'd say it's fairly expensive. Like it's fairly
like accounting and all that other stuff.
It's fairly onerous and expensive to start your own investment company.
Yeah, sure. So this is like a nice little packaged up trust-like structure that you can use to invest in if you'd like to go down that route. I mean, what's the unique value proposition of this? Is it purely high income owners who are investing in high dividend stuff who want to pay less tax?
I mean, the main marketing spiel of it, and I think that's what drives the popularity of it, to be honest, is that it's a tax effective investment because it's only 30% tax rate, which is probably less than you're paying. And then you can get it out tax free after 10 years. But both of those things are misleading because you can only get it out tax free after 10 years because you've already paid tax on the gains the whole way. And it's 30% tax. Okay, that's fine. So you save tax on dividends maybe, but you're also getting harvested on the capital gains. So both of those things are misleading. So it's not actually anywhere near as good as I guess the label would suggest. So, but then there's also rules as well. Like you can only invest a certain amount in a given year. And then you're also kind of beholden to the 10-year sort of time frame. Like if you want to take the money out after 7 years, for example, there's a penalty. Like it gets added, the earnings from the fund get added to your assessable income at tax time or something like that. But you there's a rebate involved. So it honestly gets a bit murky and a bit complex. And for that reason alone, when I looked these up initially after someone told me about them, I just started getting annoyed. Like they were unnecessarily, like I'm like, this doesn't sound right. This is kind of confusing. So just kind of like, that's red flags for me. If something's either confusing or like overly slick marketing or something, I'm like, I don't know about this. I don't know if you get those vibes as well, mate.
Yeah. I'm a little intimidated already.
So there's also, with these funds, there's also higher fees. So the investment bond providers themselves who set these up, they also charge a fee. So already from day one, you're kind of going backwards in terms of fees, and you're hoping to make it up in tax, which you generally wouldn't unless only on the income side, but on the growth side, you're really not, because you don't get the capital gains tax discount. You're going to be paying that 30% tax rate on all your gains anyway. So it's a little bit tricky. I'd say there's only a couple of cases maybe where they're worthwhile using, and they're kind of very specific cases where you might be like trying to gift the money to a child and protect the money at the same time or something like that you can imagine how a trust would operate as well, or like some sort of estate planning or something, or you're worried about getting sued, because all of these little things, you technically don't own the asset at that time. So there can be some benefits of having this other structure in between, in this case, an investment bond or an insurance bond. But if the goal is to just invest for a kid, which sometimes it is, then just using like a normal kid account or minor trust account is the proper term, I think. Just using that is probably better, and it's obviously a lot simpler and easier as well, and less fees and less complexity and all the rest of it. So I'm generally not the biggest fans of these things. They're probably not as good as the marketing makes them out to be. But I think they potentially get pushed a bit because they get advisors get paid commissions on them, I believe. So that could have been part of the popularity of them in the past.
Sure. I mean, they sound old school just by how you describe them.
Yeah, they probably are. If you look up the history of them, they probably are very old. But yeah, I think it's just a lot of maybe clever marketing that's difficult, honestly, for most people to sift through, because it's not exactly straightforward and simple to understand. So I suppose if you were wanting to try and invest in a slightly more tax efficient way, obviously there are other things you can do, such as what we've talked about in the past, debt recycling. We've discussed that a few times. You can add money to your super. That's tax efficient as well. Or you can just simply invest in high growth, low yield ETFs in your personal name, and that'll be relatively tax efficient as well. But if you're interested in, diving into tax a bit more and our thoughts on different aspects of saving tax in various ways or strategies, you can go back and listen to I think it was a 2-part episode on taxes. But for most people with insurance bonds, investment bonds, probably don't bother. Just stick to your normal, simple ETF investing, because you're probably not going to be better off with these things.
Yeah, I did say it in an episode where we talked about family trust too. It's important to remember that the reason that some of these things like direct ETF investing have gotten quite popular is not because they're dumb and they're for dumb people or anything like that, whereas the smart people are using this stuff. It's often just because it's gotten so easy. Like you wind the clock back 20 years ago and like investing in an ETF was difficult, and using an investment bond was also difficult, but I'm sure it was closer to difficulty. You still needed to call someone and organize all of this. So it's like there's a reason that we're seeing certain things become less popular, and it's just because other things have been made easier by regulation or competition, other products, other companies, services, things like that. So, things aren't too simple to be good. They're often simple because people thought they were good and wanted to make them simpler for everyday people. So, don't be alarmed.
I think that's part of the appeal too, and part of why different investments have become more popular over time, is that almost everyone in the modern world really values not only transparency, but simplicity as well. And obviously low fees and low complexity as well, because people don't have time to dig into the details of things like this. So they're just like, it sounds too hard. I'm not interested.
Yeah, 100%. And I like that you keep it simple. And if you ask someone who's listening to this and like, oh, this sounds like it could be good for me, and you're not even yet an investor, just at least start simple. You can always explore this stuff down the line. You don't need to go and, be super complicated about everything day one. just get started. Cool. So I think that's there are three main questions for today, Dave. Obviously, we had a question about market highs, in which we kind of talked about, quick summary of that was that markets are often at all-time highs because markets are generally drifting up in this positive world of ours over time. But if you're nervous about it, there are strategies you can use to mitigate it, such as putting in some of your money or all of your money spread out over time. We also talked a little bit about geared ETFs and geared superannuation and the fact that these geared or internally leveraged products are starting to provide the powers of leverage that people seek from things like property, but providing it in an ETF environment. They're getting more diverse, they're getting more intricate, they're improving their products over time, and that can make them great long-term strategies, and in particular, a great long-term strategy in super because of the fact that you can't touch your super, so it's easier to stay stress agnostic about what's going on in your super. And then we talked about investment bonds, which confused me immensely, but Dave did a great job at trying to make sense of it for me. Just a bit of an old school product that may have certain use cases, though, for the everyday person who's just trying to build a long-term portfolio, to grow or to build income from, they're probably overkill.
Good summary, mate. I think if you guys got value from the show today, I really hope you did. If you did, I'd love it if you could leave us a 5-star review in your podcast app. That really helps us get the podcast to more people and help people realize that this is a podcast worth listening to. And as always, if you have questions for us that you'd like us to answer in a future episode, again, you can hit the link in the show notes and provide it to us there, or you can send that to us at hello@aussiefirepod.com. Or, of course, you can reach out to us on our socials. So you can reach out to Hayden and Perla at Perla Socials or myself at Strong Money Australia. So that's it for this one, guys. Thanks for tuning in. I will catch you in the next episode.
Thanks, everyone. We hope you enjoyed this episode of Aussie Fire. For more FI inspiration, head to Perla.com to browse our resources, calculators, and community insights. Perla is an authorized representative number 1281540 of Sandland Private Wealth Pty Ltd with AFSL number 337927. Knowledge is power, especially when investing. So always seek advice and/or check out the relevant disclosure document for any financial product, including the PDS and TMD before deciding. These are available from the product issuer's website. When you invest, your capital is at risk and past performance is not a reliable indicator of future investment returns.